Good afternoon. Welcome. Thank you for joining us today. This is the Family Office Insights Arthur's Roundtable series. We're super happy to have a friend and a private equity expert with us today, Brian BUEHLER. It's a fun story how we met. We ended up going to Madrid for a conference. We didn't go to the conference with my friend Neil Green, but we ended up enjoying the fine dining, and then Neil said, let's go to Portugal. And so we went to Portugal and went to Porto, and that's where I met Brian. And we've been conversating and acquainted ever since. And so we're super happy to have him here in the Family Office Insights program. Also, I want to thank Pre-iShare and the Fundication Show for hosting us at their studio in Salt Lake City. So this is being recorded, so we're going to try not to edit anything out so you get all the good stuff. So, Brian, thanks for coming to Salt Lake again. You were here a short while ago in Park City and visiting, and we got to visit for a little while. And thank you for agreeing to come back and talk about your firm and you and what you're doing. Can you give us a little background to start?
Yeah, first, thanks for having me here. Just always an opportunity that I look fondly of when I get to talk to someone that I become friends with, but then trust me with sharing of intel on just kind of our view or my view on what's happening all across the different markets. In terms of my background, I'm one of the 4 managing partners of Triton Pacific Capital Partners, which is a Los Angeles-based private equity firm. And we're a generalist by nature, but we do have some disciplines that we've kind of skilled up over the years. And one is on our healthcare side. We have another vertical that's specialty finance. And then our last one is basic goods and restaurants. And as we kind of look at the markets, we kind of start to look at the different markets through those different lens or thematic themes, if you will, to kind of see what the heck's going on and where we can create opportunity for all of our capital sources, which typically are family offices, ultra high net worth individuals, or registered investment advisor firms, and in some instances, the broker-dealer world. So really excited to kind of look at private equity. And then given my exposure over the last 25 years in finance, starting off when I think I was 19, accidentally getting hired at Merrill Lynch.
Accidentally. Yeah.
There's a story behind that for another time. But kind of slowly maturing in my skill set, and along the way meeting a lot of really interesting people, I've developed not just in private equity, but commercial real estate and other aspects in finance. So really, really interesting in terms of some areas being dynamic, and other areas I'm really focused on capital raising efforts and everything in between. So thanks for having me again. Really appreciate it.
You're very welcome. So let's talk about a little bit. Oftentimes people, when they talk about private equity and they're not in sort of the world that we live in, family offices, high net worth investment platforms, that sort of thing, they automatically think of Blackstone, BlackRock, and all the big ones, and some of the narrative that's associated with them doing things that are at scale and not necessarily in the best interests of the general population, which is largely untrue, I think. But aside from that, where do you fit in? There's the State Street, BlackRock, Blackstone, et cetera. And then, in the continuum of size, where do you fit in that? You don't have to disclose the AUM, but,
Yeah, so I would define us as a boutique private equity firm where we have enough scale and size to really influence a sector that we may participate in, but we're still boutique enough to where we can quickly move and shapeshift to take advantage of certain market dynamics. So across the different verticals that I mentioned a minute ago, as it relates to the larger Blackstones and KKRs and Ares and firms like that, you're right. I mean, the scale is significant, and what they do in one deal, we may do in an entire year or 2 years. But when you look at private equity and just the definition of private equity, just so everyone's level set, is really just investing in a private business that's not traded on an exchange. So that could be a company that makes these chairs that we're sitting on, or the microphone that we're talking into. It doesn't have to be some large conglomerate that would require a company like a Blackstone or a KKR to really invest heavily into it to scale it up. So when you look at it from that view, it's kind of sky's the limit in terms of identifying opportunities, identifying good small American businesses, and then giving private investors and family offices another way to invest in America. And at the end of the day, America is built on private equity, in my opinion. If it wasn't
No
for
doubt.
private equity firms and ultra high net worth families, this country wouldn't be as dynamic as what it is. So it's quite an honor to be able to play in the field of private equity, knowing that, just a short 6 years ago on one of our verticals, we were thinking about entering the restaurant world. And now we employ almost 10,000 employees, meaning 10,000 families that we now have a stewardship of and a fiduciary responsibility to act in the best interest of not just our investors, but in that instance, the families that work for us. So it's really a fascinating economy just talking about private equity.
Yeah, so I know, or I don't know this, but I'm pretty sure you don't own Dunkin' Donuts. But, when I heard the byline for Dunkin' Donuts, America runs on Dunkin', I love the patriotism of what you're saying because America runs on small businesses.
That's right.
Whether it's the plumber down the street, the guy just fixing, we had a guy come and clean our windows and he's super happy, feeding his family. And, this is what America's built on. So you're preaching to the choir here of being a fiduciary and responsibility, keeping those families employed. And so they can, with dignity, make sure they take care of their families. So, yeah. I mean, there's more to it than just, oh my God, these big private equity companies with big buckets of money you're going to take advantage of. And I don't mean to take it down that road, but oftentimes that is the misperception.
Sure.
Let's talk about deal sourcing. Where you've got years of experience, you have partners, you have people that work within your firm. Is there any trends going on in deal sourcing now?
Yeah, it's variable. Depends on the sector. Depends on where the market's at and what it's doing. So let's talk current events, right? Look at inflation. Look at interest rates. Look at the latest CPI numbers that just got picked and framed yesterday. We're thinking now based on whoever you're going to read in the current Bloomberg reports that maybe we'll see two softenings of interest rates between now and the end of the year. Is that good? Well, maybe for some. Is it good for others? Maybe not. Depends on what side of the house you're playing the cards on. But when we look at just interest rates, it changes what you can source from a capital standpoint as well as from a debt perspective. What's the appetite for the banks, and are the banks obsolete in certain markets, and in other markets they're on the main stage? Equipment leasing, by example, we've got a vertical in our specialty finance that's equipment leasing, and banks can't and or don't, by mandate or based on their underwriting, regulatory, can't react as quickly as maybe a small business owner needs when they just signed a new contract and they need to buy or lease 3 more trucks, and the bank's going to tell them 90 days, and specialty finance within equipment leasing can bind, underwrite, and fund within 48 hours. So there's dynamics there that exist that you have to spend some time on. But from a deal sourcing perspective, we've got tremendous investment banking relationships. We act as an investment banker in some cases as well. So depending on the vertical that we're in, we may have 20 or 30 relationships that are feeding us deal flow on a monthly basis. In other scenarios, we may be bringing in experts in that particular sector that have played in that field for 20, 30, 40 years, and they know that we can show up with capital on time. They know it's not just about the capital, but it's about the business and the underlying people. And so then you look at deal sourcing and matching it up with the right capital. Because if you have super aggressive capital that wants to use a ton of leverage, kind of like 1980s LBOs, maybe that doesn't make sense in the current environment that we've been playing in the last couple of years. But as interest rates start to go down, if they go down anytime soon, then maybe you can utilize some more debt. You've got the ability to take advantage of certain deals that are sourced because maybe they require more debt to take down the whole deal or portion of the deal or club in with another group. So capital sourcing for us is important. We have 5 or 6, depending on the quarter or month, deal capital sources that we work with. That way we're diversifying our own risk in terms of if the Money Dance song plays, you got to show up to the Money Dance with your shoes on. Shoes meaning the money. So,
and the ability to close is paramount, right? So oftentimes people will come that are maybe not as seasoned or not as mature, not as well connected, and the assurity of closing has a lot to do with being able to source deals, right? I mean, if you can't close or it's suspect, then that's problematic.
That's right. Yeah, I mean, you're not going to get deals brought to you if they don't have confidence that you're going to be able to close.
Yeah.
I mean, I just lived this for the last 2 weeks with my partner. We were talking offline, right? And it's like, deal's all locked up until it isn't. And then you've got 10 days to cure it. And thankfully, we've got great institutional partnerships and family office partnerships that we were able to do what we needed to get done on that deal. And because we showed up immediately behind that, we just now went under LOI for another 108 units within that same sector on a different company. And it's because they had the confidence to know that, hey, if we work with Triton Pacific and we work with these guys, that they're going to honor their commitments. They're going to show up when they're supposed to show up. And all that is part of the ingredients to deal sourcing and capital sourcing.
And it doesn't happen without longevity, experience, trusted relationships, that sort of thing. It's not, sometimes people think, oh, it's just money. Well, no, it's not just money, right? It's being able to demonstrate over time that you can deliver from a capital, providing capital perspective, and also credible deal flow. And you're going to run and operate companies and not screw it up, right?
Yeah, I mean, most people think the world runs on money,
Yeah.
and it really runs on relationships.
It does, indeed.
And if you don't have the relationships, you're dead on arrival. And how do you have the relationships? Well, just do what you say you're going to do and do it. And I had a phenomenal mentor coming out of college a long time ago, and well known around the world, represented the U.S. in a lot of cases back in the mid 90s, early 90s. And the one thing that he really impressed upon me on was it doesn't matter how much money you make if your relationships aren't intact, it's all for naught. And so I've kind of taken that and created this theme for my own life, which is when I'm done doing business in life, and I don't know when that's going to be. I don't think it's going to be anytime soon because I have too much fun doing it. But when I'm done doing business in life, really my only goal is and should be, can I call anyone I've ever done business with, and will they want to take my call?
And will they want to take your call?
And it doesn't mean every deal works, but it's how you manage the relationship and how you were transparent and how you communicated. And those all are part of the relationship building and maintenance of relationships.
Indeed.
I know we're kind of digging in on relationships.
No, that's okay.
But that's what the business is really all about.
It's the basis of being able to move forward, right? Like if you don't have all that, and what's the old saying? It takes years to build a reputation and a few seconds to blow it up. We have a lot of questions here that I want to get to, but before we do that, talk about and it's relationship based as well, but is half your sourcing of capital come from institutions, half from family office, half from family offices that look like institutions? What's that look like?
It's really a mix. It comes from 5 different places, and we've been very deliberate on diversifying our capital source, because when we first started the business back in 2001, it was really institutional. And institutional partners are great, but there's a lot of pushing and pulling in those contracts to get the dollars to flow. And it makes sense depending on the deal. But as we matured as an organization, so did our view on capital sourcing. And so we moved into family offices, and then later continued that route and then enhanced our capital sourcing into registered investment advisory firms, and then continued that process and went into broker-dealers, independent broker-dealers. So for those listening, maybe not the Merrill Lynches of the world or Goldman Sachs, but these independent
broker-dealers,
you've never heard of their name, but they control billions and billions and billions of dollars.
As do the registered investment advisors, because they have had clients for years and they are trusted, and they're boutique-y. probably not the best way to represent them, but they usually represent a fair amount of each registered investment advisor could possibly represent millions, hundreds of millions of dollars that they have under management, and they can have discretion or not discretion, but they can direct capital, right?
Yeah, absolutely. I was on the phone with one of our capital sources. That's a registered investment advisor firm. They've got, I think, 30 investment advisors that kind of work underneath them, and they're 6 or 7 billion in assets.
Yeah, it's meaningful.
And they've placed, sizable amount of business with us in one of our verticals. And one of the promises or commitments that we make as a firm is, if you give us $1, I got to take your call. Right. Maybe not at 12 o'clock at night, but
Right.
I'm going to set up a call and take your call and answer the hard questions, because they ultimately have to report to their investors, and their investors, they're not slouches, right? These are going all the way back to what has built America. It's their clients are most likely very successful entrepreneurs, and that money's really important to them, and they may count on that money for business decisions or lifestyle decisions. So it's all connected. It's this circle of financial life. It's really all connected. And when I get on the phone, sometimes I even have the privilege to talk to investors directly. And I've always asked the support operations staff and sales staff, don't tell me how much they put in. Because I want to make sure I treat the person that did the smallest amount as much as one of our institutional partners, because truly I think that's what they deserve. Yeah. And that carries itself throughout our whole organization culturally, which is, to me, very important.
Yeah, smart. We talked before the show a little bit about the trade that went off the rails, and you brought it back on. Can you talk about that? Because it's super, super interesting. And if you can't, it's okay. I mean, you don't have to talk about the trade.
Yeah, I can talk about a high level.
Okay,
So one of our verticals is basic goods and restaurants, and it focuses on fast food restaurants or quick service restaurants. And so we were in the process of buying a significant portfolio of a certain brand in the marketplace. And really in the 11th hour, there was some changes into the terms of the deal from one of our capital sources. And so we had to very quickly, within 10 days, solve that problem so that we can show up on time, right, with capital and close. And the reason I think we were able to successfully do that was, again, just going back to this theme of relationships. It's you got to do what you say you're going to do and do it. And the terms that we end up locking in made sense for the portfolio, made sense for the investors, and I think long term it's very accretive. I can't go into the specifics of it.
It was just what I wanted to get at is exactly that you wouldn't be able to rescue that deal, so to speak, had it not been, doing what you said you were going to do in the past.
That's right.
Yeah. So let's. It's going to sound like I'm reading these and I am. So forgive me, but I want to make sure I get it right. Given the state of the private equity markets relative to broader economic conditions, what is your opinion on LP limited partner deal flow to specific sector themes? Moving upstream to macro rhetoric, how do you feel about private equity exits in the coming quarters?
Yeah. So thematically, there's variables, right? Depends on what your skill sets are, what your capital source interests are. Certain capital sources might be interested in restaurants. Certain capital sources might be interested in healthcare or biotech or pharmaceutical. So you have to match those first, right? And then if you don't have the skill set, then you have to go out and find it and hire it and bring it in-house and then figure out how to make all that work within
which is a
the deal.
daunting task, right?
Oh, man, I remember on our restaurant vertical, we ended up hiring a very, very well-known operator that basically moved here when he was 15 from Cuba and has been in that space ever since, from some of the largest franchise names that you can think of. And I think our interview process with that person, along with probably 20 others, took almost 9 months before we landed on this gentleman. And that process paid off because we got truly a phenomenal operator, and one that fits right into our culture, which is on top of the things we've already talked about, it's a pennies and seconds world. Yeah. So if you're not watching the clock every second, you're not watching every penny hit the register, there's slippage. And if there's slippage, ultimately it's going to jeopardize the investment. So the process is fascinating. So from there, then it's thematically, what are limited partner investors looking for? So it goes back to, depends on the investor. So we target certain investor types based on certain themes that we're investing in. And that's a long process. It doesn't happen overnight. It could take 2 to 3 years to really develop a new theme or a new sector, new skill set. And then it may take another year or so to really cultivate the dollars to show up. And then you're off to the races and you can start to scale. So we went in the restaurant vertical from an idea, and we called it internally Project Relatable, because who hasn't heard of brands like Pizza Hut or KFC or McDonald's or Taco Bell or Dunkin' or what have you? And it's slowly morphed into, its current state. And when we think about attracting certain dollars to that type of a deal, not everyone's into restaurants. So it does take some time. But once you get there, now we're, with this last transaction, one of the top 10 largest quick service restaurant operators in North America. And depending on the metrics, maybe the numbers even improved from that. So it all gets back to treating the investors right, communicating properly, having full transparency, showing up when you're supposed to show up, execute when you're supposed to. And then when things don't go right, you got to tell people about it. You got to be transparent.
Give me the bad news at the speed of light, right?
Yeah, because when it's dark and windy and cold outside, most people, they just stay stay inside. And what I've told our teams is put on a coat, lean into it. It's going to be cold and it's going to be tough, but when the storm's done, you're going to be that much further along. And if we do it that way, that means our investor base, those LPs, will be that much further along. So it's a cultural thing for us in our organization. I'm hoping most private equity firms and asset managers share that same mindset. But we definitely do within the walls.
I think as a rule, my experience is they're pretty responsible.
Yeah.
Or else they wouldn't get capital. But maybe digging a little deeper, the heavy lifting of getting a theme under control and understanding it, and then identifying the investors that are authentically interested in that theme. How much wiggle room or what happens when you've identified the investors, you've taken the heavy lifting to become experts in the theme, and you've taken the time to find the investors that are interested in that theme? Is there a 20%, 30% slippage when the investors say, we're not interested in that anymore because it took so long to get really good at knowing those investors?
Yeah, square peg, round hole, right? So it's probably 50%. Maybe even more.
That's what I suspect.
In some cases, it's a lot more, right? You've got capital commitments, and now you're ready to execute. And the capital commitment that was a year ago.
Mandates change.
Different mandate, maybe different economic situation for that family office or for that institution or for that investor. So then you got to figure out, okay, who's the next one in line? And you don't want to treat them like it's an assembly, because it's definitely not. But that's why the diversification of capital sources is so critical in our business, because people change their mind. And it's not because they're fickle, it's just life throws you curveballs, and you got to know how to step out of the box, and other times you have to learn and know when to swing the bat.
People who've made a lot of money are often criticized by people who would like to make a lot of money, but they don't get it. And so what I think that what people don't realize is that there's risks involved in everything. And if you're willing to be an entrepreneur and take those risks, then the reward makes sense, right? I mean, you could just, if you were just a reasonably sane person, that connecting those dots makes sense. If you're willing to take risks, then the rewards are acceptable, right? What we just described is that you've, as a firm and many others, have taken the time to become experts on a theme, taken the time to get to know the investors, and there's lots of variables that are out of control that you had to take that risk right? Some risks you can quantify, and some you can't because they come out of left field. I mean, look at COVID and all that. So my point is that you're building a firm like you've built. There are risks that you've taken on that arguably should be rewarded.
Sure. Yeah, I was interviewed a couple months ago, and they said, we'd like to congratulate you on your success, and and this and that, and they almost phrase it if it was overnight or all at once, and it's like
it looks easy from the outside.
Yeah, it's
right?
like and I would categorize it as modest success at best, right? If you look at the whole playing field of success out there, and go, thank you. Yeah, I remember 4 a.m.s to midnights for months and months at a time, and then it went to 5 a.m. to 1 a.m. So it's the same amount, just maybe more
different
sane
slot,
hours, right?
Yeah.
So it's fascinating when you're an outsider looking in, and you can look at that from a deal flow perspective, right? There's so many folks out there, and I've been guilty of it too, where you look at a deal and you're scratching your head going, why did they do that deal?
Yeah.
Those numbers don't pencil out. But unless you're in the boardroom and you're on the investment committee,
nuances,
and know the nuance,
a
lot of stuff may look crazy, but if you can solve it for X, man, there's a lot of upside potential if you can do most of the things right, because no one's going to do it all right. But if you can, the table stakes, right? If you can do most of the things correctly, then chances are you're going to have some success. And that's what I count on. It's the law of probability. It's making sure that you do as much as you can correctly in the things where
out of your control,
out of your control. Yeah, exactly.
Totally. I want to get a little bit of later, if we have time, on the effort of a lot of technology type people are saying, wait a minute, you can sift through your deal flow with AI, and you can make decisions right up to the 11th hour on. There's so many nuances in a deal, right, that can't be calculated by math, right? I'm not talking about the numbers penciling out. I'm talking about the data points, right? So let's move on to this. You've stated markets are shifting from public to private. How will high net worth investors access investment themes traditionally available via traded markets, but demonstrably moving or staying into the private sector?
Yeah, I think we were talking about it in a different setting. So I don't think we talked about that yet here. But there's been a massive shift over the last decade, and you can simply use your favorite search engine and find the numbers from the public markets moving private, right? You can see how many firms there were and how many stocks there have been that are no more or have gone private. And I think that holds true in terms of family offices and high net worth individuals and registered advisory firms they're participating in the public markets, but man, it's tricky. And I was watching, great example, GameStop.
Yeah, I know.
The last 72 hours. Like, why did that do what it? And then you have a trail behind it with AMC, and they're benefiting too, and none of it makes sense, and the balance sheets really don't support it. And so I was reading this on a flight earlier this morning. I was reading this document, and it talked about the focus on sensible investing, fundamental investing, quantitative investing, qualitative, right? And they kind of go through these different kind of views that you can have. And IT, AI, I'm not as techie as most folks. I can hold my own and make my computer not work on accident with the best of them. Yeah. But with AI, I was doing an interview about a month ago, and now I speak fluently 20-something languages.
Amazing.
And it's me with my mouth and my voice and my intonations speaking Cantonese and speak Farsi, and it's incredible. And so we can get our message out to so many more folks in an authentic way without translation because technology is available.
Yeah.
In a different way to look at it, we do use AI in a lot of manners with our underwriting, but then at some point it has to get handed over to a human.
To a real person.
And then the human says, this all makes sense on paper.
Doesn't smell right over here, right?
Yeah. So I think AI, as long as it's, in my view, if you're using it to enhance what you're doing, you're probably going to have a better opportunity of success than if you're replacing a human to do it.
Yeah.
So there is that component of it. And in underwriting, it can save us, on $100 million deal, it could save us probably a couple $1 million in underwriting costs.
Yeah.
So I do feel the efficacy of technology and AI has a definite place, at least how we utilize it.
It's a very pedestrian use case, but we use it daily just to make the narrative sound better, or have it, multiple versions where you don't have to agonize over it, right? And so that it does very well. And of course, we're going to see what comes out where I forget the name of it, but where they're going to be able to create movies,
right,
with graphics and real pictures and people. And I'm not doing a very good job of it, but it's pretty amazing. And then, we use ChatGPT every day, right? And very pedestrian way, but it saves us a lot of time.
That whole world is rapidly changing, almost, it seems like on a daily basis. But when I was in college, it was computer science, right? Maybe you should have that major, and it's, you go to Stanford, that's the majority of the population, right? And it makes sense based on where they're at. But are you learning how to code, or are you now learning how to prompt? Because the coding is all happening in real time with AI. So now you have to tell AI how to do it in a manner.
Learning how to prompt, right?
So it's the prompt. So are there going to be degrees in prompting?
Yeah, I'm an efficient prompter.
Yeah,
right? Exactly. Right?
Yeah, managed prompting.
Yeah, exactly.
I don't know what all these resumes are going to say, but technology, I've always loved it, and like you've put it, in a pedestrian way. But I also know, my own ceiling of ability, and then you bring in the skill set that really can help enhance that.
So you talked about being able to tell your story in what would otherwise take you to learn a different language, or somebody to do the voiceover. I think we talked about this a little bit. There's an effort underway to redefine what an accredited investor is. And that redefinition is in Congress and so forth, but let's assume that it gets some legs. And the traditional way to define an accredited investor is how much money you have in a variety of ways. And people have argued that just because you have money doesn't mean you're a sophisticated investor and in a position to understand and take the risks associated with investing privately. The proposal is that you can take an exam, and that exam will give you a credential that will basically authorize you to be an accredited investor. Have you heard about this?
I have, yeah. It's licensed to drive.
Yeah.
Right?
Yeah.
If you too can sit behind a wheel for 30 seconds and get your exam, and I'm joking a little bit.
Yeah,
I respect the Department of Motor Vehicles in whichever state we're talking about. But so there's this securities entrance exam, right? Introduction exam that a lot of folks can take now without being sponsored by a financial institution. And it's not an easy exam. We've got employees that have, been in the finance world for years that all of a sudden want this designation for whatever reason we need them to have it for. And they may take 30, 60, 90 days. And these are, ex-attorneys, ex-CPAs, analysts, very smart folks. So it gets back to your comment of you can have all the money in the world and not be sophisticated. You got to really, you lift it up one more level and say, why do you want to invest?
Yeah.
Right? If you understand why someone wants to invest, you can probably help them get to a place of comfort with your deal or a certain sector or a certain theme that's taking place in the market. But I think accreditation in general should be enhanced. The dollar today is different. I mean, strawberries are $10 a bunch now. They used to be a lot less.
I think I met her at one of Neil's thing, Driscoll. Did you meet her?
Oh, yeah.
Driscoll.
Cheryl Driscoll. Yeah. Wonderful lady.
Yeah, so nice.
She's really got an interesting project she's working on overseas.
I haven't heard about that, yeah.
Really, yeah. She's as honorable as a person that I've met. Yeah.
That's the way she struck me, too.
Yeah.
So besides the rewards of being a private equity investor, the rate of return, Why do you think that appeals to high net worth family offices, that sort of thing?
It goes back to a comment I made a couple minutes ago is you've got the traded markets and who knows what they're going to do.
Yeah.
Back when I was at Merrill Lynch a long, long time ago, my mentor described the market as Christmas. Every day you wake up and you don't know what's in the box, but you get to unwrap it and you get to find out. Could go up, could go down, could go sideways, who knows? And I think to your question, I think the smart money, the institutional money, the family office money, the accredited investor, the investor that's sophisticated, I think they're, in my view, looking for a way to smooth out that risk. So it's the ultimate diversifier. And whether it's private equity or it's private credit or a mixture of both, or maybe it's private real estate, if you blend those three together, and I'll just kind of throw out a blanket bucket, but look at the old 60-40 equity bond environment versus modern portfolio theory where you're adding another 30% of alternatives and reducing that equity bond position. Maybe that provides an investor, depending on the performance and the market conditions and the firm that's managing the assets, et cetera, it gives some diversification so that when the market goes down, and it always goes up and it always goes down, it gives some security, maybe, whether that's financial security or just emotional security or relational security.
Confidence in an operating company. Yeah.
Yeah. I mean, I was talking to someone a couple weeks ago and he goes, I'm only a real estate investor. And I said, oh, well, tell me why. And he goes, because I can look at the rent rolls and I can look at my cap rate and it's very predictable. And I said, I totally agree. But what private equity is the next layer below, which is owning the businesses that pay the rent that are part of the rent. So, and guess what? If there's a problem at the firm, you're the last to know it looking at a rent roll.
Yeah.
I'm the first to know it as a private equity investor.
Yeah.
So I think investors are trying to look for different ways to diversify their risk and also diversify their upside, because I don't think being in the markets 100%, at least for me personally, makes sense. But I don't think that being in the private markets 100% makes sense for me personally either. So diversification, I think, is it's huge. And so the family offices, as they get more sophisticated, and they definitely, and you know this, they've gotten much more sophisticated in the last decade than they've have ever before. They're bringing on chief investment officers. They're bringing on a team of analysts. They don't want to just get quarterly reports from a PE firm. They want to understand the intricacies of a business, because when a multi-billion-dollar family enters into a position as a co-investor with us or other private equity firms, there's trust there, but it's not blind trust.
No, it's not.
They definitely want to know what's going on.
They want to have domain expertise so they can
absolutely
make a call independent of the call you may or may not make, and have the confidence to make that call, right? So one of the things that I think, if you don't mind me sharing some insights about family offices, is that oftentimes the first or second generation of a family office, if they decided to form a family office, are more apt to, assuming they've sold the operating company, they're more apt to invest in the domain of which they know. And so they're really comfortable in that.
100% agree.
And as the generations go on, the stay rich money, let's call it that, might be in the public markets. And then the expertise of the operating company that was the original, let's say, matriarch or patriarch that caused the wealth, that tends to dissipate unless the operating company is an ongoing thing, or they continue operating companies that were in a similar domain expertise. So it's really interesting to see the farther they get away from the genesis of the wealth, the more they tend to either diversify, not be interested, stay in the public markets, want to be in, and instead of doing 60-40, do the 30-30 and 30 or whatever the number. So the farther they get away from how the money was made, the more interested they are in alternative investments in the public markets and so on.
Yeah, I agree. We've definitely found that, and as we look to partner with family offices, we're looking for family offices, to your point, on which ones have made their wealth in the sectors that we participate in and have influence over. Yeah. Because not only are they a capital source, then they become also a think tank for us. There's brain share there that they can say,
totally,
we've seen this. You guys have been in this for 10 years. Yeah. Our family's been in it for 50 years. Yeah. And have you thought of looking at it from this angle? Or if you have, this is what we found. And so it's 1 degree off from there. And it can be very helpful. So money's important. Knowledge is important. And that expertise from experience is paramount.
Yeah. I just interviewed a notable family office executive from a very well-known real estate family in New York City, now in its 3rd generation, and they still own massive skyscrapers in the real estate, which is how they made their money. But they've expanded into the real estate entertainment business, still anchored by the real estate asset. But it's interesting how they haven't fallen too far from their knitting.
Sure.
Right? It's fascinating to see how they've grown as well.
But it's not so surprising, right? So we have 3 children, and I look at, we've got a daughter who's about to graduate her master's program. We've got a son who's a sophomore in college, just finishing his sophomore year.
So fun. Yeah.
And then we have one that's graduating high school. And you look at these 3 children and you love them all equally but different, because they have so much different interests from one another. And one really has an interest in, hey, what's dad's doing? One is, I'm really interested in doing my own thing. And then one is completely off doing something different. And maybe something that I kind of secretly have always wanted to do, right? So it's really fascinating.
Are you gonna tell us what that is?
Yeah, it's our oldest, and she's a marine scientist.
There we go.
We've talked about her
this.
privately, and it's fascinating how these 3 children can really kind of represent what you and I are talking about, where within a family office setting, 1st generation to 2nd generation, and maybe apple falls close to the tree. You get to that 3rd generation, or now we're coming up really on 4th generations in a lot of these family offices that are, multi-billion-dollar families over multiple generations. And it's great what great-great-grandpa and grandma did, but I want to participate in this area because it has an interest to me, and I have the means to do it.
Right.
But I want the expertise, so I'm going to go out and find it. And then enter stage left, you've got, a team of analysts, a team of, working underneath the CIO, and then they're interviewing firms like ours saying, we want to partner with you guys, and I want to do something different, but we're not going to completely leave where our family came from, right? Yeah. So there's that dynamic to it too, which is pretty interesting. And then it's fun from my chair because I get to meet all these different folks that have tremendous experiences, and it just makes me realize, what a small but big world we get to live in, and what a treat it is that I get to do what I get to do every day.
Yeah, my kids have never understood what I did, but I never told them. That's been a lot of fun. So, without putting you in a box, your firm, generalist private equity firm. How does that help you, and how does it not help you?
It helps us being a generalist because we don't have an immediate bias. Meaning, I'm not only doing restaurants, or I'm not only doing pharmaceuticals, or I'm not only doing media, or not, right? So it's what is the opportunity set across all of these themes, all of these sectors, and then where is there white space in there that we can do 2 things. One, we can take that market that's highly fragmented and defrag it. And then second, how do we scale it? And if you can take a hyper fragmented market and put it a different way and consolidate it, and you can take that consolidation and then institutionalize it in scale, there is so much opportunity and dollars to be made for everyone involved. It's not always going to go right, but you got a really good opportunity if those two parts of the cake, if you will, of ingredients are built into it. And so being a generalist really gives us an opportunity to look at a lot of things and then pass or dig deeper and then pass or dig a little deeper and get excited. And I mean, I look at the restaurant space, and back in 2015, I'm sitting with my partners and I'm going, I'm plant-based. I have zero interest in doing these restaurants. I don't eat this stuff.
Yeah.
And so I had to get out of my own way and my own bias to look at the business model and say, wow, there's over 200,000 restaurants in the US that are mom and pop owned and operated for fast food restaurants. And over 60% of them are owned by a smaller, an aging population that has a smaller group set of children that want to stay in that business. So if we can tap into that business and consolidate it, and then bring in smart money and institutional money and family office money and all these, and then scale it up and create significant efficiencies, wow, this might be a really good business to be in. It's a hard business to be in. It's a grind. I mean, this is a marginalized business, but then we diversify because then we're in other businesses and other sectors. So I think being a generalist gives us an advantage because we don't have that bias, but then we do have to go out and really find the right operators that are skilled, that know exactly what they're doing, that can then tolerate being managed by a private equity firm. Because there's great operators out there that can't work for a PE firm.
Yeah.
Because
it's been my piggy bank all this time, and you can't tell me I can't do that, right?
Yeah. So and we're going to hold their feet to the fire in every which way to Sunday, because from a fiduciary standpoint, I have to.
Yeah.
So, and I want to get as much juice as I can out of every deal that we're into. Why? Because then there's alignment with the investor and then with me, our firm, because our carried interest is the alignment with the investor, right? I'm not really making a lot of money on 2%, fees, right? Like that pays for the lights and the staff, but it's the carry interest in the back end
that's where you're really making money.
Is where you make the money. So the ability to be a generalist and look at all these different opportunities and then focus on which ones make the most sense and have those two key characteristics that I mentioned, the ability to consolidate, the ability to scale, it becomes a pretty attractive environment to play in.
Is it fair to call that what is often referred to as a roll-up?
Yeah, that'd be another way to discuss it. Yeah, you can definitely say that. I think in one of our verticals, we've got a series of different operating businesses underneath portfolio companies that we may one day decide to roll it all up or consolidate even those businesses and then go upstream to a larger private equity firm or hedge fund or institution that may not have the expertise, but they definitely have the money. And there's trillions of dollars sitting on the sideline right now and more to come.
Yeah.
And they have to place money because it's burning a hole in their pocket. So they have to be prudent. So then how do they demonstrate prudency? They got to go find the right money managers, the right private equity firms to partner with. And so then they can use those capital. They can go ahead and meet those capital commitments and then rely on us and have us do what we're supposed to do. So again, it goes back to the whole financial circle of life. It's all intermixed, and roll-up strategies, I think, can make sense. Yeah.
So let's talk a little bit about that money sitting on the sidelines. Oftentimes, the private equity construct is, a commitment with a drawdown, so you don't have the friction of the fees on undeployed capital. Do you see that the money sitting on the sidelines is experiencing the friction because they took down some of the capital and they can't deploy it?
Probably. I think there's a percentage there that would apply to. When you've got billions of dollars sitting earning rates today, you're okay.
Not so bad. Yeah.
Not too bad. I mean, really, if you look at what's the treasury at today? It was like 3.47, I think, on the 10-year. And as I was driving here, I think I saw 50 different billboards from loan officers, with their beautiful faces saying you can get a 30-year fixed for 6.58.
Yeah.
I think that's the number today.
Hurrah! Right.
We're back to where? We're back to 1999.
Yeah.
Right? Because 98 is when we dipped below 8, and by 99 we were in the 6s. So historically, interest rates aren't that bad for the consumer. So when you look at it from a borrowing perspective and you're looking, okay, what's SOFR plus X and what's the positive arbitrage there of using that capital, it can become attractive to sit and wait because your money's not hurting you. But as interest rates hopefully maybe start to move and soften over the next couple quarters and hopefully the next couple years, there's going to be more pressure on asset managers that are sitting on money that can't earn an interest rate of 8, 9, 10, 11, 12 right now.
Cuts both ways, right?
It really does. Yeah.
It's the old saying, where you stand depends on where you sit, right? Could hit you from both ways.
Yep.
So what's in the future for you? Raising a new round? How's that work? Are you guys always raising money?
We're always raising money because we've got diversification within our own verticals.
Yeah.
So one of my partners runs our healthcare services side, and they're right now in money raising mode because they've got a very viable and aggressive mergers and acquisitions schedule starting in Q3 through really the end of 2025. On another vertical, we're actively raising capital both from our family office relationships, REAs, and broker-dealers. And those are structured differently to where investors can come in at really low minimums, $100,000 to access private equity, which is almost absurd, right? So there's that element to it, but we're constantly raising capital right now. We just went under a letter of intent on 108 units within our restaurant vertical of another brand that we're already one of the largest operators in their system. I think we were the only agreed upon buyer for that transaction, which makes it kind of unique, meaning it's not a best and final 11 o'clock at night, put your bids in and hope you get it, but it's because of going back to relationships, because of our relationships with the brands, really we're a preferred buyer, if you will, and that gives us and our investors opportunity that may not exist in other asset classes. So we're always raising capital, and some of our capital is based on capital calls, and in some of our strategies, we do weekly closes, and investors are admitted into the funds every Friday, and they start earning interest and they start getting yield and their money gets to work for them immediately.
Nice. Yeah.
So there's a lot of ways to do it. I think in our current market environment over the last 10 years, I don't think there hasn't really been a time where it's not a good opportunity. Just depends on what market,
entry
what theme.
point hasn't been that critical.
I think if you're patient capital, which is traditionally private equity, which means it's 5+ year hold, then what are you timing?
Yeah.
Right. It's kind of like, everyone listening here, you're out there, you're in escrow, you're buying a home or a second home or third home or whatever it is. If you want the home, you're buying the home.
Right.
It could be today. And if it's not today, then someone else is going to buy it.
A few basis points isn't going to make any difference.
It just doesn't move the needle. Yeah. So for us, it goes back to my comment earlier in the top of the hour, which was, why are you making the investment?
Yeah.
And if you can understand the why, then most prudent, efficient operators and asset managers can solve for it.
Yeah.
So then it's not a timing issue. It's more of, why are you making the investment? And then let's just solve for the why.
Why are you making an investment, and how's this good for you, and how's this good for me?
That's right.
Right?
We're gentlemen.
Yeah.
If you're not a gentleman, you're not going to ask that second part, which is what's in it for moi, right?
Of course, yeah.
It has to be pari passu. Yeah. So it's a dynamic in a relationship where if it is one-sided, then someone's probably getting hurt.
Yeah.
So I think the why and the how match up and align together, where then you have alignment between the investor and the asset manager. And when you have alignment with that patient capital, timing's kind of irrelevant.
So private credit has enjoyed a fair amount of capital amassed and deployed. I'm wondering what you think about this perception, being mine, and perhaps others, is that with all the regulatory oversight for the investment banks, the banks that are overseen by the Office of Controller of Currency and all their regulatory stuff that they have to do, Is it fair to say that with all the regulatory oversight that was designed to protect the consumer, it's actually choked the ability for these institutions that are regulated that way to do exactly what they're designed to do, finance businesses? And is the private equity business in the throes of suffering from some of that oversight, or there's still the ability to play and be responsible as fiduciaries?
Yeah, it's fascinating. We have this internal conversation about this all the time, right? The dislocation between what you want to do and what you can do. And in the middle, there's regulations and rules and laws and everything else. And we don't live in the gray area. We're a black and white firm, right? There's a lot of firms that may kind of sideline a little bit of that. I think, if you're a banker listening, you won't like the statement that I'll make, but banks are at a disadvantage right now, right? They really can't, in a meaningful way, help private businesses that really need help with capital.
Like if you can get a loan from a bank, you don't need it.
Yeah, but
right.
Yeah, that's exactly. I mean, if you can get a loan and you're patient enough to wait 120 days, then
that's the other part.
Why do you need the loan, right? So really now there's this dislocation between banks supporting big companies and then private credit supporting big companies and small companies. And private credit is highly regulated, just as banks are, but differently, where as a private business making private loans, you have your own balance sheet to contend with, your own, your own, agreements that you have in place and contracts that you have in place that you can avoid some of that conflict. But I think traditionally banks have been there for decades and decades, and they'll continue to be there. But I think they are somewhat disadvantaged in the current environment today. Yeah.
We see it so often where people say, we could go get an SBL loan or whatever it is in small startup companies, but it's going to take 6 months.
Yeah.
Right. And we're not.
Who has 6 months?
Yeah. Not only that, we're either be not in business, out of business, not be able to start the business, not be able to finance the acquisition of stuff to sell. Right. Then you have to go and get PO financing.
Right.
Crazy rates. Right. So
I mean, we co-invested heavily with a private credit company about 10 years ago. We've been building with them and growing with them and incubating with them that business. And they just had a highly successful 4 times oversubscribed securitization. And what that means is they've taken all that line of credit that they've extended, they've swept it, and they're kind of not starting over, but their balance sheets.
They filled up their balance sheet because they spun it out and put a coupon on it, right?
Yeah. And so you had all the big names out there that participated. And so now we're in heavy, asset gathering mode to refill the coffers so they can go out and make more loans. And so that's successfully taking place. And, I was speaking with the senior management there and their view on the credit market, and they specifically focus on equipment leasing. Their average loan is under $125,000. Their average loan, 98% of them are secured personally by the CEO or CFO of the private business. And the private business needs the loan yesterday because they just signed a new contract and they need more hard assets.
Need the flow,
It's really fascinating to see firsthand at work what private credit is capable of doing for America that banks used to be able to do. And I don't mean to diss banks, because banks definitely have a place in business, but with the theme of being,
it's not their
private
fault.
Credit, the private credit companies, they're highly regulated, but they just don't have the same restrictions that banks do, and they can operate and take the risk that they feel is appropriate to make the loans to support the business. And so I look at our slogan mark that we use, and it's Invest in America. I couldn't even believe it was available when we went to register.
Wow.
Right?
Wow.
So we got.
You mean Trump didn't beat you to that?
Not this time. And I'll add my son's name, Barron. was
There
a
you
couple
go.
months earlier than his son's
All right, well,
marriage,
you
just
beat
for
him
the record.
twice you beat him.
Just joking.
Yeah, and I don't mean to diss bankers because it's not their fault.
No, not at all.
Yeah,
If they
it's-
could, they would.
yeah,
They just can't. So
totally.
they can't right now.
Yeah, the problem with the banks is that the regulators mark to market their different types of assets, and it's basically relentless, right?
Sure.
It's really hard to live under those constraints. Yeah, we're going to wrap it up here, but I want to make sure we covered everything you want to cover. This was just a conversation with you and I, so we're not. But tell everybody the name of your firm again and that you're open for business, right?
Yeah. So again, my name's Brian BUEHLER. I'm one of the managing partners, and our firm is Triton Pacific Capital Partners. We're based in Los Angeles. We've been in business since 2001. We've been in and out of different verticals or themes through that period of time, and that really highlights that generalist nature that we have. But we've created some nice disciplines, and if folks are interested in connecting with you and me about how to work with us, then our current focuses are basic goods and restaurants as one vertical, the other specialty finance, and then the third is healthcare.
Healthcare,
and
right.
and that's a very diverse universe when you talk about healthcare. But so that's what we're currently doing, and I foresee us really focused on those areas over the next several years. But we're not closed to doing business with folks, and we're not closed to, or I should really rephrase this more positively. We're open to doing business, and
It's okay. We got it.
and we're open to thematically, continuing on that kind of generalist hat of looking at the markets and seeing, what's available to us. So appreciate you having me here. It's such an honor to be here and be your
it's
guest,
my
and
pleasure.
and have a friendship with you. So thank you very much.
You're welcome. I think that we could do a Joe Rogan podcast because there's like a million things I still want to talk about. But maybe if you're open to it, we can do this again.
Yeah, love to do it.
Yeah, that'd be
Absolutely.
great. And thank you all for joining us. I know this has been recorded, but thank you for joining us if you get to listen to it, and appreciate that. And as I always say, thank you for spending with us the only thing you can't make more of, and that's your time. And thank you, Brian.
Thank you.
Appreciate it. Okay.